So you can remember last time we started accounting analysis. So you have an idea about the purpose of accounting analysis. So you have to do the accounting analysis before you do financial analysis. So you have the idea now. Then we study under accounting analysis, you will have to analyze investing activities, financing activities, and operating activities. Because these three types of activities are reflected in your financial statement. So last time we started analysis of investing activities. We have discussed about cash equivalents. Then we started analysis of inventory. So we have studied three types of costing: FIFO, LIFO, and weighted average cost. So these three types of inventory costing has different implications on financial statement. You see, if the company follows FIFO method, you see, if the company follows FIFO method, cost of goods sold is not at current cost, because current cost goes to the inventory. Then the old cost comes to the cost of sales. So this is an issue. This is an issue in FIFO method. So we'll discuss about this. Then you see, if the company follows LIFO method, the cost of goods sold value is okay, because it is at current cost. But under LIFO method, inventory value is not okay, because it is at past cost. The inventory value is not at current cost. Right. So under LIFO method, the issue is with inventory. But under FIFO method, you have an issue with cost of sales. So we'll discuss these 2 points. Then we'll see what are the adjustments you'll have to make to overcome this issue. Right. So once you adjusted your financial statements to overcome this issue, then your financial statement, inventory value, and cost of sales value are suitable for your analysis. Because you should make the financial statement balances, income, expenses are suitable for the analysis. Before starting the analysis, you have to make the financial statement suitable for the analysis. Right. Now with inventory costing, you find you have an issue with, 1 minute please. Right. So we'll study these 2 points. Right. So I have asked you to work out the part A of this example. Part A. So we'll quickly see this. You see this company, a trading company, for the year ended 31st March 2021. So inventory quantities at the beginning, at the purchases during the year. You see beginning price, inventory quantity at beginning at price of 250. So your beginning inventory is at the price of 250. The meaning is last year you purchased stocks at 250. By the last year end, you purchased stocks at 250. But you see current year price increased to 400. Now you see current price is higher than last year price. Current price is higher than last year price. Then during the year 90 units sold at the price of 500. So you have to calculate cost of sales, closing stock, gross profit under alternative allocation method. Right. So we'll see the calculation, then we'll see what are the issues you have when the company follows FIFO method and what issues you have when the company follows LIFO method. Right. Now you see a FIFO costing. You see a FIFO costing. Right. FIFO costing. So how much cost of sales and how much inventory value. Under FIFO costing, recent price or the inventory at recent price in the inventory value is at recent price. Then all price comes to the cost of sales. Now you see you have sold 90 units. You have sold 90 units. Then 90 units valued at all price. You see all price is 250. That's 400 units. Then cost of sales 90 units multiplied by 250. 90 units multiplied by 250. Then inventory at the end, 10 units at 250, 150 units at 400. Inventory at the end. So here 22,500. Inventory at the end 62,500. 62,500. Now you see the ending inventory. A major part of ending inventory valued at current price. You see, major part of ending inventory valued at current price. But cost of sales valued at all price. All price. So here all price in the sense last year price. Last year price. Last year price. Now let's see the gross profit calculation. Let's see the gross profit calculation. Sales. You have sold 90 units. 90 units at the price of 500. You have sold 90 units at the price of 500. Then sales comes to 45,000. Cost of sales 22,500. Then gross profit 22,500. 22,500. Right. Now you see your cost of sales at all prices. Cost of sales at all price. So during the year, you have sold 590 units at 500. Then current prices of the product, current prices of your product is 500. So this 500 is current year selling price. Current year selling price. Now you see sales at current prices. Sales at current price. But cost of sales at all price. Now you see from the current prices of sales, you have deducted cost of sales at all price. The old price is lower than the current price. Now you see there's a significant difference between the old price and the current price. You see last year price 250, but this year purchase price 400. Now you see prices, the price has significantly increased. Now you see in your statement of income, if you follow FIFO method, the current price, sales at current price, you compare with cost of sales at all price. Cost of sales at all price. Then you see the result is overstated gross profit. Overstated gross profit. Because you see last year price is lower than the current price. So your gross profit is overstated. Gross profit is overstated. Overstated. Now let's see LIFO costing. LIFO costing. So how much cost of sales under LIFO costing? How much cost of sales? How much inventory value? Inventory value at the end. Now you have already calculated. You have sold 90 units. So under LIFO method, the current prices goes to cost of sales. The current purchase price is 400. Then cost of sales valued at 400. 36,000. Right. So this 400 is current price. Then inventory. Oh, inventory, you have calculated 100 units at 250, 25,000. Then balance 60 units at 400, 24,000. Then inventory value 49,000. Now you see, major part of inventory valued at old price. A major part of inventory valued at old price. Old price. Now you see on the LIFO costing, cost of sales at current price, but inventory at the old price. Inventory at the old price. Now let's see the gross profit calculation. Sales, you have sold 90 units at 500, 45,000. Cost of sales, we got 36,000. Then gross profit, 9,000. You see cost of sales at current price. Sales also at current price. Because during the year, your selling price is 500. During the year, your selling price is 500. So this is current selling price. Now you see your sales and cost of sales on the same basis. Your sales at current price, that's the price at the price during the year. Then you deduct cost of sales at current price level. Right. But if you see a FIFO method, you see cost of sales at old prices. You see old price is lower than the current price. So lower price or lower cost of sales you deducted from sales, then your gross profit will be overstated. But if you see LIFO costing, you see sales at current price, cost of sales at current price, then you compare sales with current cost of sales at current price. Now this profit is not affected by changes in the price level. Changes in the price level. Because both at current price. You know, time to time, the price level change. Now these days, you see almost every commodity prices increase. The prices of almost every product have increased. So compared to last year, this year, you see a price level has significantly increased. That because of various reasons. Because of lower supply, reducing the supply. With the fertilizer case, you know, supply reduced. Therefore, price level increase. That's simple demand supply theory. So you know the demand supply theory, right? So demand, supply, let's say P0. Now supply reduces, supply reduces, right? Then what happens is price increase. Price increase. When the quantity supply reduces, early at Q0, now supply reduces to Q1, then what happens? Price increase to P1. So one of the factors affected in this price level increase is reduction in the supply. Right. Now you see one example that kerosene, the right. මේ දවස්වල තියෙනවා භූමි තෙල් ලිප්වල. So now we can't import those products from India because they are not manufacturing. Now we don't have. About 2 weeks back, the price increased to more than 10,000. Right. So when the supply reduces, so the price goes up. Right. Now in this example also, you see price level goes up. Price level has gone up. So in the LIFO costing, your profit is not affected by price level changes because cost of sales valued at current cost. Now you see, you have sales at current price level, cost of sales at the current price level. Then your gross profit is not affected by changes in the price level. You see, your gross profit is not affected by changes in the price level. Therefore, we can say your gross profit is economic profit. Your gross profit is economic profit. Because your profit is not affected by the price level changes. Then your profit reflects the result of your trading activity. Result of your trading. So result of your business activity. It's not affected by changes in price level. So you see, this is economic profit. Economic profit. Right. So your profit reflect through result of your operations. Through results of your operations. You can say it's economic profit. Because the changes in prices, changes in price levels have no impact on your profit. Under LIFO costing, changes in price levels have no impact on your profit. Therefore, profit reflect through operating results, real operating results. So we call it economic profit. This is what you need for the analysis, because we are analyzing the business activities. Now, if the profit include the effect of some other things, you are not getting a real analysis. Now, when you analyze, or when you calculate, for example, when you calculate a ratios, you are analyzing, by calculating ratios, you are analyzing company's business activity. For example, by calculating gross profit margin, you see how far you are able to convert your sales into gross profit. Now, if the profit include some other things, then you are not getting a real analysis information. But under LIFO costing, you have the economic profit, because price level changes have no impact on profit. So LIFO profit is more suitable for the analysis. LIFO profit is more suitable for the analysis, because it reflects company's economic profit. Now you see the FIFO profit. You see a FIFO profit, LIFO profit 9,000, FIFO profit, you see 22,500. 22,500. Now you see this FIFO profit includes economic profit, but some other things also. So what is that? Now you see cost of sales valued at oil price. Cost of sales valued at oil price. You see oil price is 250, current price is 400. Then price level change from 250 to 400. Price level change from 250 to 400. So that effect also included here. That effect has also included here. So we'll analyze FIFO profit. We'll analyze FIFO profit. Now FIFO profit is 22,500. So that includes economic profit. Economic profit 9,000. Economic profit 9,000. And the effect of changes in price level. Now you see last year price 250, current year price 400. Now you see the price difference. Price difference per unit 150. We have sold 90 units. We have sold 90 units. Then how much change effect from changes in price level? 13,500. 13,500. Now profit increases by 13,500, because of increase in the price level. With this change in price level, profit increases by 13,500. So this effect we call inventory holding gain. Inventory holding gain. Inventory holding gain. You see inventory holding gain 13,500. Economic profit 9,000. The total is 22,500. The total is 22,500. Now you see, so if your company follows FIFO costing, so you have to be careful when you are using your profit value. You have to be careful when you are using your profit value. Because your profit includes not only economic profit. Your profit may have included inventory holding gains. Then your profit overstated. If your company follows FIFO costing, your profit overstated by inventory holding gains. Therefore, your profit is not suitable for the analysis. Your profit is not suitable for the analysis. Your profit will become suitable for the analysis if that includes only economic profit. So economic profit is through operating results, real operating results. But you see under FIFO costing, profit includes inventory holding gain. The meaning is changes in price level included in the profit. Effect of changes in price level included in the profit. Therefore, your profit is not suitable for the analysis. Right. So remember, when you are using the profit values to calculate ratios, to do common size analysis, to do trend analysis. So when you are using your profit value for your analysis, you have to be very careful about inventory costing. Now you see if the company follows FIFO, profit may include inventory holding gain. So that part of profit is not, this part of profit is not, or we should not take to the analysis. We should take only the economic profit into our analysis. You can see economic profit when the company follows LIFO costing. Because in LIFO costing, cost of sales valued at current price, therefore you have economic profit. You have economic profit. Right. Now let's see the inventory value. Let's see the inventory value. Inventory value at the year end under FIFO costing. You see inventory value, we have calculated. Inventory value 62,500. Now you see, major part of this inventory valued at current price. You see inventory valued at current price. Therefore, this inventory value represent current cost. This inventory value represent current prices. This inventory value at current prices, 62,500. Right. So this represents current cost of inventory. This inventory value at current prices. But if you see a LIFO costing, LIFO inventory value, inventory value at LIFO costing, under LIFO costing, you see inventory 49,000. You see inventory 49,000. So in this 49,000, you see major part of this inventory valued at old price, 250. Major part of inventory valued at old price, 250. Therefore, this 49,000 is at all prices. LIFO inventory 49,000. This is not at current price. Not at current price. So you should take for your analysis inventory at current prices. You should take the current cost of inventory. Now you see, if the company follows LIFO, the inventory value is not good for the analysis. Because the inventory value is not at current price. So inventory value is not good for the analysis. But FIFO inventory value is better for the analysis because inventory at current price. Inventory at current price. So you should have this knowledge. Then when you do the analysis, you see how your company does inventory costing. Accordingly, you can see this kind of issue is there in the financial statement. Now let's see again. See if the company follows FIFO, what is the issue? Inventory value is okay. You can use that value for your analysis because inventory at current price. But the issue is with cost of sales. Cost of sales is at old price. You see, cost of sales is at old price under FIFO costing. Therefore, your profit includes inventory holding gains. The meaning is changes in price level have impact on your profit. Therefore, profit value is not good for your analysis. But if you see LIFO method, you see profit represents company's economic profit, company's real operating results. But inventory value is not good for the analysis. Inventory value is not good for the analysis. Right. So these are your learning points. So you have to be careful about the company's inventory costing. So practically, you have to see the nature of the company. Let's say your company provides professional services. Then you see inventories are not that high valued items. So if the company in a service business, you see there are some service businesses, inventories are not that material items. Then you don't need to worry about inventory costing. But if your company is in businesses like manufacturing, trading, right, then you see inventory values are material items in your financial statements. Then you have to be very careful about the costing. So if your company follows FIFO, then you see the issue is with profit. Your profit may have been overstated by inventory holding gains. Then you have to be careful for that. But if the company follows LIFO, the profit value is all right. But you have to be very careful about the inventory value. Inventory value. But there are businesses you see, inventories are moving very fast, like supermarkets. The inventory holding period is much less. Then you see in this kind of business, whether it's follow LIFO, FIFO method, LIFO, FIFO method, the profit is not much affected by changes in price level because they have very fast moving stocks. You see the vegetables in supermarkets, some cosmetic products. You see, they are moving very fast, right? Then they have quick purchase, they have more purchases. The inventory holding period is much less. Then you see whether it follow FIFO method or LIFO method, the price level changes have not material effect on financial statements. So when you see this, you have to see the nature of the business. Sometimes you feel the price level changes have not material effect on financial statements. Right. So this is your theory. Theory is if the company follows FIFO, you have the issue here. If the company follows LIFO, the issue is with inventory. So that's about theory. But when you put this into practice, you have to see the company's real situation. Right. You don't need this kind of adjustment for a business like supermarket. But you see, there are businesses, they have longer inventory holding period. Then changes in price level can have material effect on financial statement values, cost of sales and inventory. So in that situation, you have to be very careful about the inventory costing. Inventory costing. Right. Now we'll see How we are going to adjust financial statements to overcome this issue? Right. Let's see a LIFO costing first. LIFO costing first. So in LIFO costing, the issue is with inventory value. In LIFO costing, cost of goods sold, cost of sales at current price, then you see in LIFO costing, economic profit in your statement of income, but you have an issue with inventory value. Inventory at the end, you see a ending inventory at not at current price. So this is where you need to adjust. So this inventory value, you need to adjust. You need adjustment for this inventory value. Right. So you need adjustment for this inventory value because it is not at current cost. It is not at current cost. You have to adjust the inventory value to bring it to a current cost value. So you can adjust changes in price level. You can adjust changes in price level. So you can see how price level have changed, how price level has changed from last year to the current year. So that change you can adjust here. If you go back to the previous example, now you see in the previous example, inventory value 49,000. LIFO inventory 49,000. You see this 49,000 calculation. So how do you get 49,000 LIFO inventory? You see this calculation. 100 units at 250. 100 units at 250 price. Then balance 60 units at 400 price. $24,000. Altogether 49,000. Now you see, if you have this analysis, if you can access to internal records, you can find this. If you are an internal analyst, you have the access to the company's accounting system. Then you can see the inventory costing. You can see the inventory costing. So you can see in the accounting system, this is how the company has done the costing. Now you see this 250 price is all price. You need to adjust. Current price is 400. current price is 400. Then this 250 price has to be adjusted to 400. If you have access to internal records, so you can change the costing. Instead of this 400 price, sorry, 250 price, you can put 400 and do the inventory costing. Then you see here how much, 40,000. Then the inventory value, 64,000. Inventory value, 64,000. So if you are an internal analyst, so if you are working in the company itself, then you have the access to the accounting system. You can see the inventory costing. So any old prices applied, you can update to the current price. That you can do if you are an internal analyst. But if you are an external to the firm, like you are an investment advisor, for example, then you don't have access to the company's internal records. You have only the financial statements available in the annual report. Right. You don't have access to companies' internal records. In the annual report, you don't see this detailed calculation. Then what you can do is, with your experience, you can see how or to what extent price level change from last year to the current year. So with your experience, or by getting some industry information, you find out what percentage, by what percentage the price level increase or decrease from last year to the current year. Now in this example, last year price, you see last year price. The price last year, 250. Current year price, 400. So you can get industry information. There are industry price index. You can apply those price index values. Or you can have a discussion with some experts in that industry. So you can get industry information. Then based on that, you can see by what percentage price level has gone up. You can calculate a percentage. Now you see price level changed by 150. Last year price 250. As a percentage, 60%. So price level has gone up by 60%. 60%. Then you can apply that to the inventory value. You can see on average. So this is, let's say you approximate on average, that's 50% is enough. So you can apply your judgments. So I got 60% according to the data received from industry. But with some other information, you can judge on average, we'll apply 50%. You can apply your own judgment. But here you see a 60% increase. So you can apply this percentage to calculate inventory at current cost. You can apply this percentage to calculate inventory at current cost. Now you see inventory at all costs 49,000. Inventory at all costs 49,000. Now let's say your judgment is compared to the last year, current year prices increased by, let's say you judge 50%. Then 49,000 increased by 150%. Right. 49,000 increased by 50%. So 49,000 multiplied by 150%. 73,500. 73,500. So you can apply your judgment based on the experience, right? By taking industry data, you can calculate. So you can calculate what percentage price level change from last year to the current year. So based on that percentage, you can calculate current cost of inventory. Current cost of inventory. Right. So in LIFO costing, your inventory value, and the inventory value is not at current cost. For the analysis purpose, you need to bring that value to the current cost. For the analysis purpose, you need to bring that value to the current cost. You need to bring that value to the current cost. Right. Now let's see an example. So in your study material, so let's see this example. You see, following information relates to a trading company for the year ended 31st March 2021. You see inventory at the beginning, quantity price, then purchases, 120 units at 300, 110 units at 330. Then you see during the year, 100 units were sold at 500. Right. Now let's see, company uses LIFO method. Right. Now let's see the company uses LIFO method. So if the company uses LIFO method, so let's see the adjustments. After that, we'll see the FIFO method. Now let's say company uses LIFO method. Right. First calculate cost of sales, then inventory at the end. See how we are going to adjust inventory value. Quickly find out first cost of sales and inventory at the end. Quickly find out cost of sales and inventory at the end. if the company uses LIFO costing, cost of sales, you see company sold 100 units, you valued at recent price. You see a recent price, current price. You say current price 330. 330. Cost of sales 33,000. So 330 is current price. Current price. Then you don't have any issue with the cost of sales, because you see cost of sales valued at current price. Then your gross profit reflects economic profit. Your gross profit reflects the result of company's operating activities, economic profit. But the issue is with inventory value, ending inventory. Ending inventory. How much? Ending inventory. How much? Ending inventory. So during the year, you had altogether you had 330 units. During the year, you had 330 units. Out of that 100 units sold, 100 units sold, then you have 230 units. Then how you are going to value 230 units? 100 units at 250, another 120 units at 300, the balance 10 at 330. Then inventory value, 100 units at 250, 25,000, 120 units at 300, 36,000. Then balance 10 units at 330, 3,300. Then the inventory value, ending inventory value, $64,300. Now you see this includes 250 price. This includes 250 price. So 250 price is last year price. You see 250 is beginning stock price. Beginning stock price. The meaning is that's last year price. Last year price. Right. Now you see 250 is not current year price. It's last year price. You see current year price on average between 300 to 330. Current year price is between 300 to 330. On average, you can say 315. On average, current year price is 350. Now you see, your inventory includes 100 units valued at last year price. That's why your inventory value is not at current cost. That's why your inventory value is not at current cost. So if you are an internal analyst, you have this piece of information. If you are an internal analyst, you have this piece of information. You see, inventory is not at current price because it includes 100 units. You see, it includes 100 units valued at last year price. Right. So when you have this information, you can adjust. So what is the adjustment now? Now, when you are an internal analyst, you have this piece of information. You see this 250 is not current price. Current price is on average. Current price is on average 300 to 330. On average 315. So instead of this 250, you can apply 315. That's the average current year price. Then you can calculate the inventory value. 31,500. 31,500. Then inventory value. $70,800. 70,800. But if you are an external analyst, you don't have this piece of information. So what you have to do is you get the industry data and see by which percentage price level has gone up. Then you have to apply that percentage to the stock value. Right. Now you see last year price 250. Last year price 250. Current year price on average 315. Then you see a price level increase by 65 from the last year level 250. So roughly a price level has gone up by. Now here you get 26. You don't need to take the extract 26%. So with your other information, you can come to a judgment. You can come to a judgment. So let's say with the other information, you feel 20% is more appropriate. Right. With other information, you feel 20% is more appropriate. Because if you see the stock quantities, it is not entire stock at the old price. Only part of the stock. Only part of a stock is at the old price. So you may feel that 20% is appropriate. Right. Then you can increase stock value by 20%. You can increase the stock value by 20%. So how the purpose here is to bring the stock value to current cost. So you are trying to bring the stock value to the current cost. Right. Let's see the company follows FIFO costing. If the company follows FIFO costing, company follows FIFO costing, then how much inventory value? How much ending inventory? Quickly calculate to the same example. How much ending inventory? So during the year, you had 330 units. Out of that 100 units sold, then ending inventory quantity is 230. Ending inventory quantity is 230. Then you see 230 valued at current prices. You see current prices, 120 units at 300, 110 units at 330. 36,000, 36,300, 72,300. So these are current prices. Therefore, your inventory value is okay. That's suitable for your analysis. Then you calculate cost of sales. Cost of sales. You have sold 100 units. Then you have to value at old price. So here, the old price is 250. 250. 25,000. 25,000. Right. Now this 250 is last year price. Therefore, this cost of sales value is not suitable for our analysis. So you need adjustment for this cost of sales. You need adjustment for this cost of sales. Right. Now we'll study how to adjust this. Now, how do you find cost of sales value in your financial statement? In your financial statements, how do you find cost of sales value? So this is how you calculate cost of sales value. Opening stock plus purchases minus closing stock. You have cost of sales. So opening stock, how much? You see the question. You see the question, inventory at beginning, 25,000. Because practically, or when you see financial statement, you don't see quantity information. You have the only rupee values. How much opening stock? 25,000. How much purchases during the year? You see the question? You see that example? We have purchased 2 times, 120 units at 300, 110 units at 330, then purchases total 72,300. 72,300. How much closing stock value? Closing stock value 72,300. Closing stock value 72,300. Now here purchase equal to the closing stock. Then you have cost of sales 25,000. Cost of sales 25,000. You see, we got the same answer. We got the same answer here. Now, if you see this calculation, closing stock at current price. Therefore, this is okay. Purchases at current price. Therefore, this is okay. Opening stock at last year price. This is not at current price. So this is the point you should adjust. Opening stock at last year price. So this is where you should adjust. The stock at last year price, you have to bring to the current year price. So this opening stock at the last year price, you need to bring into the current year price. So you can find by which percentage the price level has changed. Then you have to add, you can adjust your opening stock. Now we have calculated the price level has increased by 26%. The price level has increased by 26%. So you may judge a different percentage. Let's say you judge your judgment is this is appropriate. Then your opening stock increases by 26%. Opening stock increases by 26%. Then how much adjusted opening stock? Is 25%, sorry, 25,000 increases by 26%. So multiplied by 126%. $31,500. Then you adjusted cost of sales, 31,500. So adjusted cost of sales, 31,500. Now you see this is close to the current cost of sales at current cost. You see, you get the cost of sales at current cost. If you apply the LIFO method, you get cost of sales at current cost only when you apply the LIFO method. So if you apply the LIFO method, your cost of sales is 33,000. Then in FIFO method, after adjusting your cost of sales, you get a close answer, 31,500. 31,500. Right. So the problem is with the opening stock. Because the opening stock at the last year price, you need to bring to the current year price. So by identifying the price level changes, we have done the adjustment. So you can use industry information. You can find for certain industries some price indexes. Right. In addition, you can price data. Those variations, price changes are available in the industry reports. So you can use that information to adjust opening stock value. Right. Then you have a cost of sales at current cost. Right. So after adjusting, you have cost of sales at current cost. inventory at current cost, then these two values are suitable for the analysis. These values are suitable for the analysis. So if you do not adjust, your analysis is affected. Your analysis is affected. Right. Now let's see that. Let's see how your analysis is affected if you do not adjust. Now let's again say company follows, let's say FIFO costing. Sorry, LIFO costing. If the company uses LIFO costing, in the original financial statements, I mean the financial statement you receive for the analysis. In the original financial statements, inventory value, how much? By LIFO costing. If the company uses LIFO costing, in the original financial statements, inventory value 64,300, cost of sales 33,000. So here problem is with inventory. Problem is with inventory value. Because part of this inventory is not at current cost. Therefore, we have adjusted this inventory value. So we'll take adjusted financial statements. So we have adjusted the inventory value. How much? Amount after the adjustment. How much? Amount after the adjustment. 70,800. 70,800. Cost of sales, same. Because we don't need any adjustment under LIFO method. Under LIFO method, cost of sales at current cost. So you need to adjust only the ending inventory. Ending inventory value. So let's calculate. Right. Now you see, you are using inventory value to calculate current ratio. So if you are using original financial statement without adjusting that effect, what happens is inventory value is lower. Inventory value is lower. Then what happens to the current ratio? What happened to the current ratio? Current ratio understated. Current ratio is understated. Because under LIFO method, in a price increasing situation, inventory at last year price is lower than the current price. Therefore, inventory value is understated. Therefore, current ratio is understated. Current ratio is understated. You are using inventory value as a part of current ratio. Current ratio is understated. Another example, return on assets. So if you do not adjust, how does return on asset affect? If you do not adjust, how does return on assets affect? If you do not adjust, what happens is you have your inventory value is understated. Then total asset value understated. Then how does it impact to the return on assets? Inventory value is lower, then total asset value is understated. Then return on assets overstated. Return on assets overstated. Right. Now you see, if you do not adjust, your ratios are affected. Certain ratios are affected. Return on equity also overstated. Because when the total assets understated, the equity value also understated, the return on equity overstated. Now you see, if you do not adjust, your certain ratios are affected. Certain ratios are affected. Right. So that's why we need accounting analysis. So in the analysis of inventory, we see with the ending inventory value and cost of sales are fairly reported in the financial statement. So if your company follows LIFO, you know that ending inventory value is understated because in LIFO method, all costs goes to the inventory value. Now you know when inventory value is understated, certain ratios are understated and overstated. Certain ratios are affected. These are some examples. Your current ratio is understated because when the inventory value is understated, current ratio is understated. Return on asset, return on equity ratios overstated. Then what happened to the inventory turnover? You can think of another example. Inventory turnover. Now you see, how do you calculate the inventory turnover? Cost of sales divided by ending inventory. Cost of sales divided by ending inventory. Now, cost of sales at current cost. You see, cost of sales at current cost. Ending inventory at all costs. Then what is the impact? All costs lower than the current cost. Then how this ratio is affected? Current cost higher than the old cost. Then what happens is the ratio is overstated. The ratio is overstated. Inventory turnover overstated. When inventory turnover overstated, what happens? Inventory holding period. Inventory holding period. Inventory holding period. When turnover overstated, inventory holding period, what is the impact? You calculate inventory holding period, 365 divided by turnover. So when inventory turnover is overstated, inventory holding period understated. Inventory holding period is understated. Now you see, certain ratios are affected if you do not adjust. If you do not adjust, you see some of your ratios are affected. So that's why we need accounting analysis. Before doing any analysis, you have to make sure financial statements values are suitable to do the analysis. Now this is one situation. So when your company follows LIFO costing, your inventory value is not suitable to do the analysis. Because in LIFO costing, your inventory value is understated. In LIFO costing, your inventory value is understated. So you need to bring the inventory value to current cost. Now this is current cost. Now you see after the adjustment, your inventory value at current cost. Inventory value at current cost. Right. Now you see if you do not adjust, you see certain ratios are affected. Certain ratios are affected. Right. Now let's see the same for FIFO costing. If the company follows FIFO costing, if the company follows FIFO costing, cost of sales, how much cost of sales? So let's take cost of sales and inventory in the original financial statement. And revise financial statements. Cost of sales. So if the company follows FIFO costing, you can see your answers. FIFO costing, cost of sales, 25,000. Inventory, 72,300. Cost of sales, 25,000. Ending inventory, 72,300. So in FIFO method, you have an issue with cost of sales. In FIFO method, you know, the current prices goes to the inventory. Then the cost of sales at the last year prices, old prices. Then you have to adjust cost of sales value. Now after the adjustment, how much? Cost of sales, we got this. We have adjusted the opening stock value. After the adjustment, cost of sales 31,500. $31,500. So this is more approximate the current cost. This is more approximate to current cost. This is more approximate to current cost. You see current cost of inventory under LIFO method, 33,000. You get current cost of inventory from LIFO method. You see, current cost of sales from LIFO method. You see, LIFO method cost of sales 33,000. So after adjustment, we got 31,500. So that's more approximate to the current cost. Now let's see if you do not adjust, what are the implications to the financial ratios? If you do not adjust, you see, if you do not adjust your cost of sales 25,000, then cost of sales understated. You see, it's lower than the current cost. You see, this 25,000 cost of sales, if you do not adjust, your cost of sales 25,000. But you see, cost of sales at current cost 31,000. So if you do not adjust, your cost of sales has been understated. Then gross profit overstate. Gross profit will overstate. Then what happened to the gross profit margin? What happens to the gross profit margin? Gross profit margin overstate. Because when the cost of sales understated, gross profit will overstate. Then your gross profit margin will be overstated. Similarly, operating margin, net profit margin. So all will be overstated. So all these profit margin will be overstated. Now you see, if you do not adjust, your cost of sales has been understated, then profit margins will be overstated. Now you see, these profit margin figures are not suitable for the analysis. In addition, you can see inventory turnover. If you do not adjust, what is the implication to the inventory turnover? What is the implication to the inventory turnover? How do you calculate inventory turnover? Cost of sales divided by ending stock, ending inventory. Now we are in FIFO method. In FIFO method, cost of sales is at all prices. Inventory at current price. Inventory at current price. So in an inflationary situation, current price is higher than old price. Current price is higher than old price. Then your cost of sales has been understated. Then what is the implication to the turnover? Turnover understated. Turnover understated. Now you see, if you do not adjust, your analysis is affected. This is one example. This is how your ratios are affected if you do not adjust. If you do not bring in FIFO method, if you are following FIFO costing, if you do not bring company's cost of sales to the current cost, this is how your ratios are affected. But now you see, accounting analysis is important. So before starting any financial analysis, you need accounting analysis. Because from the accounting analysis, we can make sure our financial values, the values in the financial statement are appropriate for the analysis. Right. Now, by studying this inventory costing, so we found under FIFO method, cost of sales value is not appropriate for our analysis. So we need to adjust cost of sales. That's why we have revised cost of sales value. Under LIFO method, we found ending inventory value is not appropriate for our analysis. Therefore, we need to bring the ending inventory value to the current cost. Otherwise, for example, certain ratios are understated or overstated. Certain ratios are affected. Then your analysis will become useless. Right. So this is what I have planned to discuss today. So you should get the logic. So I don't ask in the exam this kind of questions. A question similar to the examples given in your study material. So you should study the logic. Then that understanding you apply in your exam question. So you should logically study the logic. Now we have done some examples to understand these points. Then that knowledge, that understanding you have, you'll be applying your exam. Right. Any questions? Any questions? The next class, in the next lecture, we'll do analysis of, now we have completed only 2. Yes, last time we completed analysis of cash and cash equivalents. Today we have discussed in detail analysis of inventory, then analysis of receivables, analysis of receivables. So next time we can complete analysis of receivables and analysis of non-current assets. So before the next lecture, you should study LKS 16, LKS. So what is the standard number for impairment? So as I can remember, LKS 38. Sorry, 38 intangible assets. You should have studied. And LKS 36 impairment. So these three standards are important for the analysis of non-current assets. Right. So you should have studied and come. You should have studied. In addition, for the analysis of receivables, you should have studied a financial instrument standard. There's a separate IFRS and LKS for financial instruments. Right. So I'll give the standard number, because accounting standard you have already studied. You had a financial reporting. So in those subjects, you have studied about or studied on these standards. So financial instruments, there is a separate case. So give me 1 minute. I'll give you the number. LKS 32 and SLFRS 9. LKS 32, SLFRS 9. So these two are relating to financial instruments. Right. So this knowledge is important to analyze receivables. Right. So you should have a quick look at of these 5 standards, because you have already studied. So now you are in the 4th year. So you should be familiar with almost all the accounting standards. So otherwise, you have no value in the industry if you don't know the standard. So your account, you see, accounting is part of your degree. Without knowing the standard, there is no value to you in the industry. That's the reality. Right. So you can have a quick revision of these standards before the next lecture. You can do it. Then you can understand the things discussed in the lecture. Right. So do it before the next lecture. Then in the next lecture, we'll study analysis of non-current assets and analysis of receivables. Right. So we'll do it in the next lecture. Any questions you have? Now for your company, so if there's any inventory, you try to apply this knowledge. For cash and cash equivalents, you apply our the learning points in the last lecture. Then in the next lecture, once we complete analysis of receivables and non-current assets, you can apply those learning points to your selected company. Then try to do some accounting analysis before you move on to the ratios and other analysis. So you haven't started the analysis for your selected company. Now you have simply take the financial statements into one Excel worksheet. You have all 5 financial statements into one Excel worksheet. You haven't started the analysis, but before the analysis, you have to make sure the numbers are appropriate for the analysis. The numbers are appropriate for the analysis. Right. So try to apply this knowledge to your assignment, then you will be rewarded some additional marks. Right. Then, so we'll see you next time.
Thank you, sir.
You're welcome.
Yes, sir. Thank you, sir.
You're welcome.